Could we be finally taking the right steps towards peace in Ukraine? Over the long weekend, there were tangible moves made on the US side and the Russia side to get a peace deal going in Eastern Europe. And with peace brings stability. Stocks love stability, but when we dive into the details, Ukraine is not present in those talks. So is this just posturing, and what does it all mean? Especially if peace talks fall out, do we get escalation, retaliation, and at the end of it all, what happens to stocks and the financial markets? That's what we're here to talk about today, along with why Nike was up 6% today, the broad market rotation happening under the hood, and of course, earnings. The glue holding the circus together is S&P 500 earnings, and we need to talk about the concerning things that could break the earnings picture. So where do we go from here? How bad is it? And is this the end? We've got a lot to talk about, so let's roll the tape.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were slightly up on Tuesday to begin a holiday-shortened week of trading with potential policy moves by the Fed and President Donald Trump in focus. And today was actually a pretty bullish day when you look at the broad market. Nearly 70% of the companies in the S&P 500 outperformed the index itself, with more than 170 stocks rising 1% on the day. And we really saw the big guys take it on the chin today. Look at Tesla, down 0.5%. Look at Amazon, down nearly 1%. Costco and Home Depot were down in excess of 1.5% each. Walmart kind of flat, slightly down. Meta was down, breaking its 20-day consecutive win streak officially today. Netflix fell 2.15%. Google was down 0.79%, but there were a couple of winners here in the big boys. Microsoft was up ever so slightly, same with Nvidia. Apple was largely flat, and look at hardware, guys. Hardware was very, very strong. The broad semiconductor market was very strong today, and there were a couple of just big winners. Oracle was a big winner. Financials did really, really well today. It was just strong, broad-based buying across the board. There were only 3 losing sectors today, with the S&P 500 gaining 0.22%. We saw XLC, the communication sector, as well as the discretionary sector, XLY, fall, along with healthcare. But money from these sectors rotated into the broader market, with energy, materials, utilities, technology, and industrials all gaining here today. But the winner today, definitely gold. I think there's a lot of chatter about London's gold reserves, as well as a Fort Knox gold audit, just to see what we actually have. Those two result in a gold short squeeze, as well as just a general trend with the momentum we saw. But all in all, we saw a broad-based rally today. And if you actually look at market flows, the Nasdaq actually saw net outflows today, but the New York Stock Exchange saw 3 billion in net inflows, while the S&P 500 kind of traded flat line. But you saw here in the afternoon, we sort of put in a bottom and we had a little bit of a burst consolidation and then a burst upward here to the end the day, up 0.24% for the S&P 500. And it really goes to show the price action we saw. The broad market saw inflows, outflows here from the mega caps of the Nasdaq. And that is why we saw small caps, growth, core, and value as a whole outperform the broader market. We saw mid-cap value perform the best here in mid-caps, and then large caps really underperforming the broad market. But net, if you were just indexed in large, mints, or smalls, you definitely saw green in your portfolio. Now, let's actually talk about why the market was green. Number one, this is a holiday shortened trading week. Yesterday was closed, so all of that volume comes into today's session, and that's why it was broadly green. We're also getting some really positive movements in Ukraine, especially on the geopolitical side. The market like certainty. Now, US and Russia are engaging in peace talks in Saudi Arabia at the moment. This is the first high-level talks we're having in years. Now, Ukraine is not present in these peace talks, and they're not happy about that. However, there's a bunch of European countries there as well. And this is really, really positive for the movements in Ukraine and a really good step at forming peace. The market recognizing that, and European stocks have been incredibly bullish over the last 3 to 4 trading days. And on the back of this news, Europe as a whole was actually very, very bullish. Not much red, a lot of green, and Europe has actually been on fire for the last 4 trading days, and especially this year to date. Another reason why we saw markets move today was
actually did have a lot of earnings movers. Now, Nike was up 6.19%. They announced a new partnership with Kim Kardashian and her brand Skims. They're going to launch a collaboration, and investors kind of viewing this as a step in the right direction for Nike, up 6% on that news. Now, SMCI was up 16%. And again, they released earnings last week, very upbeat guidance. The CEO coming out and saying we can do $40 billion next year in revenue. The market consensus expectation right now is for $34 billion. So we'll see if that's possible. But the company is also taking steps to avoid its delisting on the NASDAQ. SMCI said it's on track to submit its delayed SEC filing by NASDAQ's February 25th deadline. And the stock is up 30% in the last 5 days. The market liking what it's seeing. Personally, I'm not in this name right now. I'm not a big fan of companies with accounting fraud, but let's say the fraud situation wasn't there. SMCI is definitely a stock on my watch list I'd be looking at. But anything to do with accounting violations, my money won't touch it. Nonetheless, a lot of individuals have made money on SMCI. Now again, on semiconductors, Intel up 15%, and there's reports that Broadcom, TSMC, Oracle, Elon Musk potentially picking up the pieces here for Intel. They're looking at M&A talks, and a simple sum of the parts valuation probably puts Intel stock closer to like the $40 mark, and that is why we're seeing the stock rally on the back of these rumors. Nothing confirmed just yet, all rumors, all speculation, but the market doing what the market does best, and that is buying the rumor. Now, Walgreens, very similar to Intel, there's M&A rumors going around. Nothing we know for certain. They were up 13%. Someone is likely coming to pick up the pieces. Stock up 13% on the back of that news. Now, for everything we saw today, we had a pretty positive day, guys. We had 3,300 advances, 2,900 decliners, and market momentum looks very strong. Shorter term, medium term, and longer term moving averages looking very, very solid across the board. This is the market you kind of just want to hold your equities in, buy the dip, especially when you get opportunities like these, and just ride the momentum to the upside. We will see momentum to the upside in 2025, a lot of volatility as well. But all you really want to do now is the positions you have, hold, average up, and go from there. Now, equities were positive across the board. The S&P 500, the NASDAQ 100 up 0.24%. But this was actually a big flurry we saw here at the end of the day. I mean, heading into 2 p.m., 3 p.m., equities were pretty negative on the day, flat to negative on the day. And then we saw a huge flurry here in just buying activity into the end of the day to finish the day up 0.24 and 0.23% for the NASDAQ 100 and the S&P 500. The IWM was one of the best performing indices today, up 0.55%. The RSP up 0.77%. So the broader market outperforming the market cap weighted indices. And then we also saw mid caps outperform, S&P 500 outperform. Definitely a day for that value rotation, that value trade from sort of these growth names into the rest of the market. You kind of love to see that, especially with what earnings is doing. It was simply inevitable. Now, looking at other movers here today, US yields were up 1% here today, and the dollar also gained. Now, again, this is just on the back of maybe some of the geopolitical developments and some of the domestic developments we're seeing. There is some underlying tariff news as well, but for everything we're seeing right now, yields did increase today, but equities simply did not care. Also what did not care about the rise in yield? Gold up 1.26%. So very, very interesting developments we saw here. Everything was just on a tear today, except bonds. TLT was down, the AGG was down as well, but offset somewhat by a stronger dollar as a result. But let's actually talk about the S&P 500 and where we are again. If we actually look at the gamma zones compared to where they were last week, we saw the gamma flip move up, and we also saw the core resistance move up ever so slightly. Now, there is a little bit of room to run to get to the 6140 area, man, and the gamma flip was at 6100 just last week. Crazy to see that movement to the upside. But yeah, a little bit of upside. But unless we actually go significantly higher, do expect a little bit of resistance and potentially some downside here from these levels. Nonetheless, this is another all-time closing high for the S&P 500, a great way to kick off the first day of the trading week with an all-time high. And that was coming on the back of some weaker than expected data we got towards the end of last week. Nonetheless, equities brushing away the economic data, saying the fundamentals are strong, and we continue to rally to the upside, closing at an all-time high. Again, we are at the top end range here of the core resistance, and until the this actually moves up significantly, do expect resistance and a little bit of a movement to the downside. Nonetheless, the long-term trend is to the upside. I'm just saying, based on what we're seeing right now, when equities get to this level, we tend to see a little bit of movement, particularly in the back end half of the week. Very similar situation with the Nasdaq 100. We should actually see a little bit of downside here, but that's another closing all-time high for the Nasdaq 100. You love to see it. It's absolutely beautiful to see this again. The market saying, the market just ignoring some of the macro developments we're seeing and saying, hey, the fundamental picture is good. 18% earnings growth excluding energy. That is very, very strong. And equity markets telling you that is what they want to see. Now, guys, we are in positive gamma and you do want to buy any dips we do get. So if we do see a pullback in the Nasdaq 100 and the S&P 500, you want to buy that dip for us to go onward and upward. We're seeing a very strong trend here. We put in a higher low relative to this low right here. Higher highs, new all-time highs in the Nasdaq 100 and the S&P 500. Strong momentum. Now, if you are looking for a little bit of value, you can actually look at the RTY. We're not at the top end of the range. So we might actually see a little bit of divergence based on the price action we saw today, where we do see stuff like the RTY, the RSP move up, and then we do see some flatline trading, maybe a little bit of a pullback in some of the larger names. Nonetheless, net, I think everything should move up in unison. I'm just saying we might have a little bit of outperformance in the RTY, the Russell 2000 to end off the week. Nonetheless, very strong momentum we saw here today. New all-time highs. The RTY not quite at a high, but look, once we go ahead, break this level right here, the core resistance level, I think we're going to go onward and upward for the Russell 2000. We should see very strong buying once we break this 23.25 level and go from there. Let's actually have a look at the RSP, what they're doing. The RSP, again, this is looking like a higher low, relatively speaking. All the RSP needs to do now is go ahead and break above, use this as resistance, and then make the next move higher, targeting these all-time high levels. But this price action right here, looking very constructive for the RSP as a whole. Looking at the 10-year yield, we're seeing a little bit of consolidation here at the 4.5 level. The market probably seeing this as equilibrium for now, and we're either going to make the next move down or the next move up. I think it's really going to depend on what we see with Ukraine as well as tariffs and the global market. I think that's really going to impact where yields are going to go. Also do look at some of the domestic macro. We did get New York Empire State Manufacturing today. That was a lot better than expected. That could explain some of the moves we did see in yields and the dollar. Nonetheless, we're at a critical zone, finding support and resistance at these levels. Support here, resistance here. I think yields are looking to make the next move to the upside or the downside. The dollar is looking a bit more favorable. It's looking like we are actually in this downtrend. Unless we go ahead and actually break above this level right here, we can see a move up, but then find resistance, move down, and that would be a lower low, continuing the downtrend. I do think we want to see a weaker dollar, particularly towards the end of the year. I think that's going to be really supportive for equities as a whole and just the global macro market, particularly as it pertains to tariffs and a potential peace deal in Europe. A lower dollar, a weaker dollar is just going to bode well for everybody as a result looking forward for this year. So we do want to champion a lower dollar. That should come with lower yields, but we'll see how everything pans out. In the here and now, on a technical basis, the dollar looks like it wants to go lower, but we do know these are very volatile assets and more dependent on the macro more than they are the technical as a whole. Now, gold, both actually increased their gold target to 3,300. That could explain part of the reason, but 3,300 gold. My target for gold was 2,000 at the start of this year. Literally at the start of 2025, I said 3,000 gold is on the tickets. I thought we were going to see that in September, October, November. No, we are here in February, mid-February at the 3,000 level. And guys, if you look at the last year of gold, in simply the last year, gold is up, I think, nearly 50%. Absolutely insane. 45% from the move, pretty much from 2,000 to 3,000. We saw a huge move, very linear returns here in gold. Some pullbacks, as you can see right here, quite a bit of volatility here. We definitely did get pullbacks, but gold has been resilient through and through. Bitcoin continues to do what Bitcoin does at around this time of year. Seasonally, between now and sort of like the October area, Bitcoin tends to do one thing, and that's consolidate in a very wide range. So do expect Bitcoin to continue to do that, and we make the next move up. One thing that is supporting the Bitcoin price right here is institutional buying. They are buying right here. What is this level? Let's have a look. Here at the 90,000 level, institutions are buying in a very big way. BlackRock, State Street, Vanguard, Michael Saylor, and everybody in between. So you definitely do want to be a buyer of Bitcoin at these levels. I am bullish. My price target is 130,000 for Bitcoin end of year price target. But guys, you know exactly what to do. Any dips we do get in the S&P 500, buy those dips. In the NASDAQ 100, buy those dips. The RTY has already had its dip. You should be long, and we're aiming for the 23-25 area. So guys, continue to hold the line. The fundamental picture is sound. The macro picture is sound. The technical is looking really, really good. The only thing you want to do in this market is hold and then do nothing. Be patient and buy any dips we do get.
And let's talk about sentiment. This is Goldman Sachs US Equity Sentiment Indicator, which just combines 9 measures of positioning across institutional, retail, and foreign investors, and has historically been a statistically significant signal for near-term S&P 500 returns. Pretty much anything above the zero line means positioning is this much bigger than it was last year at the same time. And if it's below this line, it means positioning is actually lower than at the same time last year. And what we have seen is a decrease here in sentiment while still remaining above the zero line. So we're not in stretch positioning, but people are still holding equities and positioning is still a net positive looking forward. And this probably does mean we do go higher, and any dips we do get vis-a-vis a pullback in sentiment, probably an opportunity for you to buy those dips. I think what the market is really looking at is earnings, guys, and I cannot stress this enough. Earnings have been some of the greatest earnings we've seen probably since 2021. And before that, probably 2017. I mean, we're looking at 15.3% earnings growth, really led here by financials, comm services, and technology, but particularly these two sectors right here, financials and comm services, right? Both in excess of 30% earnings growth. We also did see margins tick up ever so slightly relative to the consensus expectations. Now, guys, if you actually just exclude the dumpster fire that is energy from these earnings, right, you're looking at 18.7% growth, 2 times what we were actually expecting as per the estimates coming into this earnings season. And it really goes to show how strong earnings have been. And this is a real positive. And it's why the market has been so resilient in light of all of the volatility and news we've seen. And just for the record, we've actually had 383 companies report in the S&P 500. So this, barring Nvidia fall apart, is probably what we're going to report. Maybe we go a little bit higher, but very, very strong earnings. And that has led us to valuations being quite elevated. Now, this is consensus 12-month forward PE valuations by sector. And you can see that the S&P 500 is in the 91 percentile versus the 10-year average, the 94 percentile versus the 30-year average. Things looking quite expensive. In fact, expensive across all sectors on an absolute PE basis. The only cheap sectors here being energy, right, as well as real estate. And that's because earnings are growing, the macro is looking very, very good, but also over time, a lot of these businesses have become more tech focused, and that has improved margins over time. However, when you look at the PE ratio versus the S&P 500 against history, right, the 10-year and 30-year, you can actually see that there is quite a number of cheap sectors, relatively speaking. However, on an absolute basis, we are looking very, very expensive. So pick your poison as you will. However, guys, this isn't a particular reason to sell. When you look at the actual composition of the overall market, again, being led by technology, industrials, consumer discretionary, I think based on the growth and where we're going, the AI theme, you really do deserve these higher valuations. And also, businesses are just far better now than what they ever were. I mean, you even look at a typical staple company, right? Online delivery, how they're able to track what people buy via memberships and that type of thing. Businesses have become far better at determining what customers want and getting it to them more efficiently. And I do think, relatively speaking, that does demand higher valuations. And that's what the market is really telling you right now. And as long as we keep the economic environment we are in right now, as well as the earnings environment, I think we will move higher. Stair-step, of course, but we will move high. Now, the S&P 500 has traded sideways in a 6% range for about 3 to 4 months. In periods when we have had this is all the gray lines, okay? When we have had this type of consolidation, it was in stuff like 2008, 2022, 1990s, right? it's either led to a massive move to the upside or it's marked cyclical tops in the S&P 500. And how you know if we're going to move higher or lower depends on the breakout we're going to have. Historically, you want to see the market definitively break that 6% range and close 3% above it. So what you really want to see the market do is close at about the 62.80 level. If we can go ahead, make it close at that level, what we should see is a significant move higher over the next 105 trading days, pretty much over the next 3 to 4 months. We should see the S&P 500 move higher. So what we want to look for is a break to the upside. However, if we break 3% to the downside, this is what normally follows, and we can actually see a 4% pullback, relatively speaking. However, the movement in the S&P 500 is largely going to depend on the macro. Now, we did get some updates here from Goldman Sachs with regards to the economic data we got yesterday, and US manufacturing production declined in January. So they lowered their Q1 GDP tracking estimate to 2%, and they lowered their domestic final sales forecast to 2.2% by 1 percentage point as well. So stuff you don't like to see, but still 2% growth, largely healthy. What we also saw with regards to core PCE is that retail sales was well below expectations, import prices somewhat below expectations, estimating 0.29% for January core PCE. In other words, they decreased their inflation rating here for the month of January. Now PCE is the Fed's preferred gauge of inflation, and this actually might bode really well for equities, especially if we get a cool PCE print based on cooler than expected manufacturing, retail sales, and import prices. But we don't want to see these decline significantly because that can actually turn into a growth scare. The market doesn't like those. So if we actually see inflation come down and a little bit of weakness in the economy, that's okay. That could mean the dollar moves down, yields move down, but we don't want that weakness in the economy to turn into a growth scare, because at that point, the market just sells risk assets, goes to safety, and that's a whole new can of worms. Now, something else we're seeing is the Doge boys, Elon, and all of the people he's employed in the government, they're actually cleaning up the government. And this is Kelsey's forecast, right? The betting market's forecast. How many government employees will Trump and Elon cut in 2025? The forecast is 231,000. And this number has actually been steadily rising, as you can see, right? This might actually add to a weaker non-farms number. And again, this is a good thing long term, but in the short term, growth scare, lower inflation, retail sales, all of this could turn into a massive growth scare. And that's something you don't really want. And that can provide opportunity, but it also creates a lot of nervousness and uncertainty. So we'll see how all of these things play out. And then looking at earnings for this week, now tomorrow, Wednesday, before the open, we actually get Etsy, Solar Edge, Wix, Fiverr, and that's pretty much it. Wingstop as well before the open. And after close, we get Carvana, Toast, Cheesecake Factory. So we get a whole bunch of really pivotal names, high beta names, more names in that smaller mid-cap space. Really good to see. And then we actually do have quite a number of names reporting Thursday and Friday as well. On the earnings side, we have building permits, housing starts. That's really the market moving events, as well as the FOMC minutes. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.